This is your LMAX exchange technical update for Friday, May 5th, 2017. Euro dollar. So the euro continues to extend its gains, its run to fresh 2017 highs, and we have to now pay attention to this first objective, which comes in around 112.30. If you look at the market's run since basing out by multi-year lows in January of 2017, we've since seen a series of higher lows and higher highs, and this latest breakout above the previous 2017 high after the market had traded down to 105.70 projects a measured move that takes us up towards the 112.30 area. If you consider 105.70 is that low and that previous high that was in place around 109, then you have about 330 points that need to be covered on a measured move basis that again takes us up to 12.30. If you also consider though a broader formation of a potential longer term inverse head and shoulders, that would project a more significant upside if you consider the break of the neckline and this structure towards the 114 area further up. Again, when you have an inverse head and shoulders with the base at 103.40 and the highs up around 109, you're talking about 500 points plus of a move in that measured move, a measured move to the top side off this inverse head and shoulders, and that takes us again up towards and above the 114 area. So right now the focus clearly remains on the top side, but it's also worth noting that this run does look a little extended, so there is a risk for some form of a correction before the market considers trading higher. That is a possibility. If we take out the low, that initial support from the Thursday low, which comes in around 108.75, that will take the immediate pressure off the top side and suggest the market may want to fill that gap from the other week between 107.30 and 108.20. If at that point it does do that and plays out and takes out that gap and fills it, then we'd be looking for a higher low in continuation of this uptrend. Ultimately here, the focus remains on the top side. The question right now is just whether we see an initial correction before heading higher or the market just continues higher from where it currently sits. At this point, it would take a break back below 105.70, that previous higher low, to negate the constructive outlook for the euro. Sterling dollar. So cable has been doing a very good job consolidating above the recent previous resistance, that multi-week resistance that had defined the top of a range after the market had traded down to plus 30-year lows in October of 2016 at 118.40. The break above 127.75 is significant, as it suggests we're seeing a shift in the structure here from a sell on rallies type of a structure to a buy on dip structure. With that said, there is risk that we see a short-term pullback following this move higher, but any setbacks now should be very well supported into previous resistance around the 125 area in favor of a continuation of gains up towards what is a measured move objective for this market in the 135 area. That is, if you consider on a conservative basis a rough consolidation that we had seen of 700 points between 120 and 127, that 700 points beyond 127 projects a move into the 135 area, which coincides with some key resistance going back to 2016 around June of 2016. Dollar yen. So dollar yen had taken out some key resistance at 112.20 this week, which was a significant break, taking the immediate pressure off the downside. But it's worth noting this falling trend line that we've seen going back to early 2017, with the market stalling out by that falling trend line on Thursday around 113. And this could suggest that the market wants to adhere to this downtrend and roll back over. If we see a close back below 111.75, that will really strengthen the outlook, while a break and close back above the recent high from Thursday at 113.05 would negate that possibility and suggest the market is still more comfortable trading to the top side with that downside pressure, at least for now, alleviated. Euro Swiss. So Euro Swiss has been consolidating its recent run of gains, and this market though does still remain well capped below some key resistance at 109, which could be a lower top on a more meaningful longer term downtrend. At this point, if the market holds below 109, that downtrend is intact, though the market would then need to break all the way back down below what has been some elusive support at 106.24, which is the 2016 low. So right now you want to pay attention to 109 above and 106.24 below, but while we hold below 109, the downtrend is intact and there is risk still for a topside failure. Aussie dollar. So Aussie continues to extend its run of declines, with the market now racing back towards its 2017 low, and more importantly, potentially down towards some medium-term support going back to December of 2016 around 71.60. At this point, any rally should be very well capped, with only a break back above 76.11 to compromise the bearish outlook for Aussie dollar. Dollar CAD. So dollar CAD has been absolutely on fire, with this market racing up to fresh 2017 highs and closing in on that next major psychological barrier at 140. It's important to note, though, when you look at the RSI on this market on the daily, it is quite extended, which could warn over the short term of a potential pullback. At the same time, on a medium-term basis, when you pull back this chart and you look to see where we're headed, 140 kind of makes sense when you consider this trend line that we're seeing off of that high that we'd seen back in May of 2016, this rising trend line, and that trend line resistance coincides with 140, which again, the 140 area is a projected measured move following this recent consolidation breakout that was roughly between the 132 to 136 area, 4 big figures, and 4 big figures higher from that breakout does project that move towards this measured move that coincides with this trend line around 140. If we do see a pullback now, they should be ideally well supported ahead of 134, with only setbacks extending back below that recent low that we saw in April, down around 132.23, 122.24 to compromise the highly constructive outlook for dollar CAD. Kiwi dollar. So looking at the weekly chart here, this is a market that has been clearly under pressure, and the pressure remains on the downside, with the market looking to establish below that previous medium-term support at 68.62, below which accelerates declines down towards next key meaningful medium-term support at 66.76. At this point, it would take a break back above 70.90, that high that we had seen back in March, to compromise the current bearish outlook for Kiwi dollar. SPX 500. The S&P 500 has been consolidating just off recent record highs, and there remains risk for this market to push to fresh record highs beyond 2,400. If we see that play out, then that means that the market would be breaking consolidation that we've seen over the past several weeks between 2,320 and 2,400. That's an 80-point consolidation, and so the break above 2,400 would project an 80-point move to the top side up to 2,480 about. That level coincides with some meaningful longer-term extension levels where that next major resistance point is for the S&P 500. At the same time, this is a market that has been exceptionally extended over the past several months and has been in a very impressive uptrend over the past several years, but we would need to see ultimately a break back below critical support here at 2320 to force a shift in the structure. Otherwise, dips are expected to continue to be well supported. On a very short-term basis, the market would need to break back below 2368 to take the immediate short-term pressure off the top side. Gold. So gold has seen some intense setbacks over the past several days, but as we've highlighted, since basing out ahead of 1100 back in 2016, we've seen more constructive type price action, with the market making higher highs and higher lows. The most recent higher high, a 2017 high, just shy of 1300. And so this pullback does kind of look like pullbacks we've seen already in previous months, and so a higher low is now sought out above 1195 in favor of a resumption of gains back towards the next measured move objective for this market around 1335, just below that critical 2017 peak at 1375. Really, only back below 1180 would totally negate the constructive outlook, but a break below 1195 would be concerning.